Welcome to the Full Tracy Money Audio Commentary. This is Owen Tracy recording. It's 3:49 p.m. that is Central Time, and today is November 11th, and it's Veterans Day in the USA. So the bond market was closed, and of course, thank you for your service to every service member and all those who've passed away in service of a free world. But I thought today I would also kick off with the unemployment level in the UK. It's at 5%. I think it's very important to look at this in historical context. At 5%, it's pretty much around where it was in 2020. And that level was where pretty much the floor was between 2001 and approximately 2007. So that, I think, highlights a couple of rather important points. One is that the economy is much more levered now because we're already talking about the possibility of cutting interest rates in reaction to this. And I think that's rather significant. There wasn't really the same kind of thinking around this subject back in 2001 through 7 because it was considered to be historically low. Whereas between 2017 and 2022, then having an unemployment rate of around 4% was considered normal. So either we're going back to the norm from back in the early 2000s, or this is problematic. Now, of course, we should give due consideration to the possibility that what we have here is a highly levered economy, and there is already very excessive spending on social programs, which would only get worse if unemployment trends higher from here. That pretty much means that interest rates are coming down. But of course, what it also helps to question is whether the UK is a microcosm of what we might anticipate from other countries, because the UK has its own unique the challenges in front of it, particularly because of the spike in government bond yields in reaction to a profligate fiscal policy that was introduced by Liz Truss and her government. And that was very sharply rejected by the bond markets. The gilt yield gapped lower today, down 7 basis points, now starting to encounter resistance in the region of both the 50-day and the 200-day moving averages. So